Welcome back, everybody. We've had a great series of sessions here in the Finance Forum at Innovation Zero. For those of you who haven't been in, welcome. For those who are staying, I understand why. It's been a great series of panels. But for all the newcomers, we started off, and I asked the question, how are we going to mobilize the 3 trillion a year, the 100 plus trillion we need by 2050? How are we going to mobilize the funding to build those 100 green steel plants by 2030, the 7 million zero emissions trucks, the 200 zero emission ships by 2030, the 20 plus CCUS facilities if we're going to have net zero concrete, etc. Big numbers and all the associated infrastructure that goes with it. How do we do what Ford did for manufacturing to financing and deal doing? Build that pipeline, that production line of infrastructure assets and financing. We've heard from infrastructure financing, very positive, lots going on, but, big growth, but still not enough. We've heard about early startup funding and VC funding. And I think several of the themes that have come out again and again is the need for the policy tailwinds, the need for clear strategy at a government level, patient capital, and risk takers. Who are the risk takers in all of this? I've talked a little bit about something we've launched at the World Economic Forum. I'm Anthony Hobley, by the way, Executive Fellow for the Centre for Nature and Climate at the World Economic Forum and co-chair of the Carbon Tracker Advisory Board. We launched an initiative to scale global philanthropy commensurate with the challenge we face to de-risk the sort of public-private collaboration we need to see. But no one needs the innovation more than the corporate sector. So in a sense, how do the corporate sector, help themselves? And corporate sector have always had corporate venture capital. So what is the role of corporate venture capital in unlocking the 3 trillion a year, building that pipeline of low carbon technologies, whether it's in steel, in shipping, in infrastructure like ammonia, clean power, et cetera, et cetera? How do we build those net zero clusters, those green corridors? How do we build a low carbon economy? And how does corporate money, corporate venture capital play a role in the ecosystem we have to build? We've got a great panel here. I'm going to hand over to our moderator for this panel, Andrew Gall, CEO, Amava, and Director of Circul Oil, if I said that correctly. Yep. Brilliant. Andrew, the panel is yours.
Thanks very much, Anthony. Welcome everybody here to Innovation Zero. I think we're having a great, engaging time with lots of the panels and the people that we've got here. As Anthony's saying, we're going to be talking today about how corporates are going to be engaging with startups in the investing stage. And I've been involved now for over 23 years, from 2000, when I thought corporates really weren't engaged in how .com was going to affect their businesses. I've taken executives to Tesla and said, guys, this is more than just an electric engine in 2008. The whole infrastructure is going to change. So I've been really passionate about how we engage corporates to change their business models and to engage with startups to change. So we've got a fantastic panel here, which goes from some of the largest companies that have got some of the biggest climate problems to some of the companies who've got lots of money and are addressing climate change. We've got engineering businesses that are now being backed by mining businesses and by finance, and we've got representatives from the early stage entrepreneurs. So that's what we're going to be covering. From my panel, we really want engagement from you as the audience, so please use Slido to put your questions in. I want to make sure that we're hearing from you, because we want to hear from you as much as just the panel sort of speaking. So please use Slido, and we'll have time as well for questions and that later. So what I'd like the panel to do is introduce themselves and their take on the climate challenge, and that to start with. So, Irina.
Happy to. Good afternoon, everyone, and thank you, Innovation Zero, for inviting me to speak to this panel. And thank you, Andrew, for moderating, and Anthony for this great introduction to our panel. I'm Irina Gorbunova. I'm a Vice President of Mergers and Acquisitions for ArcelorMittal, and I also run our corporate venture capital fund called XCarb Innovation Fund. I can talk a little bit more about steel, but I think you want everyone to introduce before I get into it.
Yeah. So, James, moving to the next large corporate on the
Thank you,
panel.
Andrew. Thanks. So hi, everybody. I'm James Lockyer. I'm from Microsoft. I sit within our Climate Innovation Fund, which is a $1 billion fund that we launched in January 2020.
Good, thank you. And
Hi.
Julian.
Yeah.
Julian.
Hi. Yeah, Julian Peck, investment manager from WAE Engineering, which has a couple of funds. The better known one is Foresight WAE, which was previously Foresight Williams, and that's the one that people may know. But in fact, the more relevant one for today is Sainsbury's Innovation Investments, which is a fund purely focused on helping Sainsbury's get to net zero. So that's a more relevant one for today's discussion. And the other thing that's particularly relevant about WAE is that we are owned by Fortescue, which is the mining company that Andrew mentioned. And Fortescue is a big Australian mining company that has committed to get its entire operations to real zero by 2030. And has put $6 billion into its subsidiary Fortescue Future Industries, FFI, in order to achieve that. So we can talk more about that later as well. Thank you.
Great, thank you. And Niels, the perspective from the startups and the people with ideas.
Yes, hi, I'm Niels Schrader. I lead the climate stream at the University of Oxford's Creative Destruction Lab, which is a mentorship program for early stage deep tech companies. So we work with 20 very scientific founders every year and bring them in a room with mentors who have all gone and built significant businesses. So most of our mentors will have exited a company above 100 million. We've got a couple of industry experts in the room who have been the VPs of innovation for Qualcomm or the head of BP, who can really help the ventures with this engagement with the corporates. And I'm here to kind of, wave their flag a little bit and give the perspective of the founders in this discussion.
Great, thank you. So, Irina, maybe we could start with you, with an industry which is one of the biggest contributors to climate. Can you explain what steel is doing to solve the problem with corporates and with startups?
That's a great question. Thank you, Andrew. I don't know how many of you actually know about steel footprint in terms of the carbon footprint, but steel industry accounts for just below 10% of global CO2 emissions. So as such is quite a contributor to the carbon footprint globally. However, we view it as an opportunity because this is really an opportunity to make an impact and to find the way to produce steel sustainably and in a low carbon and zero carbon way. Our company, ArcelorMittal, is one of the leading steel and mining companies globally, present in pretty much every continent and with a quite significant steel production. We have pledged to become carbon neutral by 2050. We also have an intermediate objective of reducing our CO2 footprint by 25% globally by 2030 and 35% in Europe, which for those of you who appreciate the technology and the way currently steel is produced, it's actually quite ambitious target. Nevertheless, we are determined. We developed a very comprehensive roadmap of how we're going to get there. It's not just one solution. There are a number of technology pathways. Some are more intermediate term, some are more long term, some are more imminent in terms of maturity. So we are looking at producing steel through the DRI, directly reduced iron route based on green hydrogen. We are looking at a route to produce steel, what we call smart carbon, using CCUS, and also direct electrolysis of iron ore is something that we are focused on. And in addition to that, one thing I must add is steel is absolutely crucial for the energy transition. Everyone is speaking now about renewable energy. You know, if you look at the wind towers or solar panels or electrical vehicles, steel is required everywhere. So as such, it's going to be critically fundamental for the energy transition. It's just we need to ensure that the way we produce it is done in the most carbon neutral manner. One more credential of steel is infinitely recyclable. So I believe that everything that can be recycled should be recycled. So as such, we are focused on making sure that we use EAF, electrical arc furnace facility, to recycle steel. And then if you use renewable energy as the energy source, you can really get to the lowest carbon footprint. In addition to one thing that to Anthony's point is a complex issue. It's not just a question of technology. There is also an element of economic standards. You know, what is green steel? There is of course also regulatory framework. We want to ensure that as a group we really lead the energy transition of our industry, that we're really at the forefront of decarbonization of steel industry. So we want to ensure that we don't leave a stone unturned when it comes to our efforts to decarbonize. So in addition to all of the technology pathways that we are developing, in addition to all of the investments we are making in renewable energy and in recycling, for instance, I made 4 acquisitions last year in recycling assets, but we also launched XCarb Innovation Funds to underpin our efforts. And the idea is to really engage with the global innovative ecosystem to see if we can identify some of the most bright and promising technologies that can support our decarbonization journey.
Good. Thank
okay,
you.
maybe I'll pause here because I can continue.
No, that's a great context, I think, in terms of being, you know, one of the biggest impacts on the environment and the stretch targets and that you've got. And then we'll come back to you on the challenges that you're facing internally in a moment. So, James, in terms of what's Microsoft doing, why are they worried about carbon, and what's the scope of your carbon investments?
Sure. So when we launched the Climate Innovation Fund back in January 2020, that was to coincide, thank you, with our commitments around being carbon negative by 2030 and then removing all our historical emissions by 2050. So the Climate Innovation Fund was kind of put together to really help us invest in innovative technologies which are going to help not only us meet our sustainability goals, but also help the broader market to really look at how we advance specific sustainability markets. So our original investment kind of criteria was based across our 4 main sustainability pillars, which are carbon, water, waste, and ecosystems. But over the last few years, of course, we are having to refine where we prioritize because the market is moving so quickly. And of course, we are monitoring and measuring our own operational emissions and impact. So a big part of our focus is really about being completely transparent about what steps we're taking. So we've just published our 3rd sustainability annual report, for example. And then we're also publishing a lot of our learnings around our efforts in terms of carbon accounting, carbon removals. And I should add that we have a sister team, which is kind of separate to us, but in the same part of the same business unit, who will look at procurement. So we have our CDR team, we'll have our water team, our sustainable aviation fuel team. And in many scenarios, we will work together on due diligence of specific solutions. There'll be some that we fund, there'll be some that our procurement team don't offtake from, and vice versa. And actually, there's some incredible examples here just today where our CDR team recently signed an agreement with Undo, who are just outside there and just standing over there as well. So I had to do a shameless plug for them because this is so important, right? The corporates have an incredible opportunity to invigorate the market, to test a few things, to kick a few tires as well, and really look at how do we advance specific scenarios. What do we mean when we're looking at low, medium, and high durability solutions? What are some of the challenges with that? What are the areas that perhaps as an ecosystem of corporate venture funds and broader kind of customer and partner relationships, you know, what are those efforts that we can make to really advance some of those scenarios?
And from Irina, I think we understand she's trying to look at the the value chain for steel, what types of ventures and at what types of stages is Microsoft's Clean Innovation Fund investing?
Yeah, good question. So we will invest typically in Series A onwards. In the portfolio today, we've made around 55 investments. About 40 or so of those are direct investments. And actually, we are co-investors in Boston Metal as a good example. And then we also have invested in around 15 fund managers. A good example is Energy Impact Partners, who have been on a few panel discussions here today as well.
Okay, great. So that gives us the context of the sorts of scope that Microsoft's looking at. Now, Julian, in terms of your fund with Sainsbury's and sort of stuff like that, give us an insight into the areas that you're investing in.
So it's a much earlier stage fund than we've just heard about there. We're looking at seed to Series A. Our typical investments are 500k initially. And we're looking at their focus areas being refrigeration, logistics, green heat, and savings on food waste and water wastage, the four key areas for the fund. The fund has only recently started, so we've yet to make our first investment, so we are keen to hear from anybody with good opportunities that might be appropriate for the fund. But what we're looking to do there is really, it's all about supporting Sainsbury's in their goal to reach net zero by 2035. They're also looking for a financial return on their investments. So that it's the sort of dual purpose of getting a financial return while helping them get to net zero. But it's slightly unusual as a corporate VC. It is technically a corporate VC in as much as the money that's being invested is Sainsbury's money. It's straight off Sainsbury's balance sheet. But Sainsbury's isn't really looking to potentially acquire these companies. Sainsbury's doesn't have a strategic interest beyond the net zero objective. In fact, sometimes with a corporate VC, there might be constraints on competitors and that sort of thing, whereas actually Sainsbury's are really quite welcoming about that and saying we want first access to the technologies, but actually after that they would be quite welcoming of other people using the technology, because if Sainsbury's have it first and then subsequently it goes into another supermarket, then that helps enhance the value of the investment, supporting the second objective of the fund, which is good financial returns.
Great, thank you. And Niels, you're at the earlier stage. What are you looking for support for up this value chain to get the corporate sort of exits that you're looking for?
Yeah, thanks. So we typically look at pre-seed, seed stage ventures across many verticals. So we look at anything in the energy transition, a lot of battery startups, things in mobility. We've got very good built environment startups as one represented here, Lower Carbon Materials is actually at, I think, F22, who were in CDL last year. And I guess we see, repetitive challenges when these startups are ready to get into the marketplace and they need to start talking to the corporates, where the language is very different, but also the timelines are very different. So quite often a startup would try to get into a paid pilot with a corporate player, and the corporate procurement cycle.
Keep going.
No? Yeah, okay. The procurement cycle from the corporate is longer than the runway of the startup. So that is a challenge for them, obviously. Then quite often you would see that startups get to an unpaid pilot and there's a lot of demands on the corporate sides of, could the product be more like this? Could the product be more like that? And you do that and you're like happy that you've got some traction, and then you get the next pilot and they say, ooh, could it be more like this time? And the startup says, yes, cool. But at some point they need to realize, okay, you can't keep doing more pilot iterations that are all catering to just one client, because you need to get to product market fit that fits more than one client so that you can scale out. So there are some significant challenges, I guess, where we need to get both sides of the table a bit closer together, and how do we do this procurement?
Great. Okay. So, look, we want questions from the audience. So, have we got any questions now, or I'm going to continue? Add some to Slido, or put your hand up in the next sort of iteration, because we've got startups here, we've got early investors here, we've got people who are looking for later investments. So, we're keen to hear from your questions on that as well. So, Irina, back to my sort of question. You're the ultimate corporate that some of these startups that are coming with hydrogen solutions, new circular economy sort of type solutions, how do they engage with you? And do your colleagues in the traditional business say, oh no, we've always done it with coking coal, or we've always done it from raw materials, why would we do this newfangled stuff? How do you engage with your core business to help these businesses to scale?
Excellent question. Thank you, Andrea. First of all, maybe before I answer it, in terms of, and you said the whole value chain. Yesterday, I was speaking to one of the venture capital funds, and they were asking me what sort of angle I take, and I say, well, it's strategic. It's for us to decarbonize steel. And they said, oh, so well, so you're like really quite limited, right? You must be, just steel. And then if you actually look at the whole value chain, it's pretty broad, because regardless of the technology pathway that we take, we need, first of all, clean energy, clean electricity. And that, of course, covers quite a broad spectrum of various startups and technologies. And then you can go to hydrogen. And maybe before I go to hydrogen, for instance, in clean energy, we made already an investment in a clean energy startup, in the solar energy, and then also in nuclear, because I think nuclear has to be part of the mix, given that steel facilities cannot just rely on the intermittent source of energy. You really need a power 24/7, and that's the reason nuclear has to be part of the mix. And then going back to the intermittent nature of the renewable energy, you also need then long duration energy storage. So we made an investment in a company that's developing a multi-day storage, so seasonal storage, which is low cost, and it's based on iron. So this is where differentiation comes from. And then, Andrew, you were mentioning hydrogen, because one of the technology pathways that we are developing is directly reduced iron based on green hydrogen. But of course, if you look at the current situation, some of our facilities can be hydrogen ready, but you really need the whole infrastructure that's connected to our facilities in order to be able to use it. And I think another issue there is really around economics. So we need a lot of green hydrogen pretty fast and at scale. And of course, there are too many challenges around it. So that's the reason we also invested in we invested in a very novel technology producing green hydrogen without membrane, because membrane is one of the most costly elements in the green hydrogen production. Still very early stages, but nevertheless can be quite interesting. Of course, then the core of our steel making is key. So that's the reason, as James was saying, we invested in Boston Metal, which is developing a molten oxide electrolysis technology to produce steel. Again, I don't know to which extent you guys are familiar with the chemistry and technology around steel making, but this is where you put iron in a bath with the electrolytes, and then you can reduce iron ore to get Fe out of Fe2O3 or F3O4. This is quite an interesting technology, and we are also developing one in-house, but then we also invested in one of the startups in this space. And as you go along the value chain, there is still, of course, residual emissions, and that's the reason we are very much focused on the carbon capture and utilization, and not even so much the capture, but what do you do once you capture the carbon. So one of my investments is in a company called LanzaTech, which is quite interesting biofermentation technology to use recycled carbon to produce bioethanol. So that's a very good example of circularity, where you take waste, and then you produce something useful.
Yeah.
But then going back to your question of how we engage. So first of all, we have a very impressive research and development team within the group with more than 1,500 people. So there is a lot of research, a lot of initiatives, a lot of innovation already in-house. But what we wanted to do, like I said, is to ensure that we also tap into the innovative ecosystem outside and work with some of those startups. And luckily, I didn't have any responses like you were saying, we want to use Coke and coal. On the contrary, I can see the group is very well determined to lead the transition and to embrace the innovation and to engage with some of the startups. So as we start looking at various companies, there were a couple of, I'll give you an example. There was one interesting plasma technology to produce hydrogen that came to us. And I was looking at economics. I thought it just doesn't make sense. But our team was quite excited about the technology. So they decided to do the trials and they tested the technology. But then alongside those tests, they figured out that you don't need to go all the way to hydrogen, that you can stop at the syngas, which is actually quite valuable for us. So something like that is an excellent example where as a startup, you wouldn't be able to figure it out on its own. It's really teaming up with the large industrial, with the platform, that large industrial and the platform that we have in order to test some of those technologies to establish their viability and their industrial scalability.
Yeah, I think you're raising a great point that there's going to be a new value chain that you're now out exploring. But from my 20 plus years in that with corporates, I think you've got to be careful that the corporate doesn't see that it's a threat to their industry. Like, I guess an extreme example with yours, if you were so good at recycling steel, your ore assets in the ground might be worth nothing. And the person who's responsible for your mining for iron ore might say, well, I'm going to be out of a business. Or like when I took the executive to Tesla in 2008, if they realized we wouldn't need petrol stations and that anymore, what are the oil companies and that going to do? So I think there's a big challenge on how we get corporates to transition to as much to a new business model rather than just applying technologies to their current space. But I think you are very good in seeing that full sort of view and that of the value chain. So in terms of engaging with Microsoft, James, how do you engage with the core business, or are you just out there investing in things that you think are just good and you don't have to engage with the corporate?
So it's a great question, and I think if you think back to some of the, I guess, the priority investment areas for us, and I kind of spoke about carbon, water, waste, and ecosystems. We've kind of refined that investment thesis, and we do look and kind of communicate to the market, I guess, some of those priority focus areas. And we're very, as I mentioned, transparency earlier. We share everything around our kind of investment criteria on our external site. If you just do a search for Climate Innovation Fund, you'll come across it. And the reason for that transparency is because, as you can imagine, we do get a lot of inbound requests. And so the best way that we can guide the ecosystem is to communicate what are our kind of investment priorities, and also signpost any interested climate tech companies to apply directly for funding. So we use an online submission process as our kind of first port of call. Outside of that, though, we do have a number of kind of different, I guess, channels that we would explore investments through. So we quite often will have some of our customers come to us to say, hey, we're looking at this too. Are you interested? But we also have our fund managers as well that will help us in so many areas like research and insights in the areas that we are prioritizing, as well as deal flow in those areas. And so, when I think about maybe CDR, we have a big focus around not only engineered solutions, but nature-based solutions as well. And so as we talk about that, of course, that's a demand signal, I guess, out to the market that, we're looking for submissions in those areas.
Yeah.
And so, yeah, it's interesting, we definitely see some of particularly our enterprise customers with really interesting kind of, I guess, subsidiaries that either they've acquired or that they're investing in themselves, which has been quite interesting. And then, of course, I guess the primary route, and I guess feedback for anybody in the room here would be that if you are interested in exploring an investment from us, then definitely go to our Innovation Fund site, and all the details, the criteria, the submission links are there.
Yeah, so I think that answers one of the questions, or there's top tips here for convincing a fund to invest in them. First of all, make sure you're in the right criteria in terms of the right sectors, looking for the right amount of money. I'd be a bit cynical about whether you're doing an application on the online form is going to be is really going to be the way to you to get
It works. It
to
definitely
get a
works.
Series A round
review all.
investment. Okay, okay, so that's good. So maybe I'll take that tip as well for a startup looking to get investment from the funds. Maybe Julian, what's because your earlier stage, which might be more relevant to the ones in the stand here. How are you engaging with those?
We also have an online portal,
Yes.
and we get submissions every week through that, and we review them typically within a week, perhaps not 100%, but pretty close to it. And we will get back to everybody who submits via that portal. It's not the only way to contact us. Obviously, if we meet a lot of people at events, we're constantly scouting for the best investment opportunities. And as I've said, this is a fund where we're specifically looking for investment opportunities now. But in terms of what we're looking for, I guess we're looking for the same things as most other VCs. So, we're looking for a good management team. We're looking for good technology. We are a tech investor, so we're not looking for Me Too. We would be looking for something where there is good technology which is protectable with some kind of a moat around it. I say moat rather than patent. It doesn't have to be patents. It could be patents. It could be software. If there's good quality software that would be difficult to replicate, that can make just as good a moat. So the technology side is very important to us. We would look for some kind of commercial traction. That doesn't necessarily mean that it has to already be selling, but we would be looking for some evidence of engagement with customers, and we'd be interested to see what level of engagement's been reached. Okay. And then we'd be building an investment thesis based on everything that we've read about the strategy that we business plan in the pitch deck that we received from you. So our starting point would be to review a pitch deck, which is therefore a very document. The quality of the pitch deck is key. After that, we would then take it to initial questions, and we would have a first meeting based on that pitch deck, and then after that, we would perhaps have a wider meeting if necessary. Is everybody hearing me?
Yeah, keep going.
Yeah. Okay. So that's the kind of early stages of the investment process, but lots of ways to get through to us. Could be via the website, or could be just by meeting one of the team, or at an event or something like that.
Okay, Niels, your engagement, how the startups get involved with Creative Destruction Lab, and how you're sort of getting them introduced to the corporates.
So we have an online portal, which will not surprise you. Now yes. So you can apply on the portal. You can obviously chat to me or any one of the team beforehand if you like. We review applications at the end of July. So we always recruit a cohort a year and then do some interviews, and typically look for things that are pre-seed, seed stage. You don't need commercial traction, but you need to have a product that works, because we're really at the sweet spot where we want to take something very technical out of the lab into the market. And if it's not ready to be thrown at the market and be battered a little bit by the feedback from the customer, then you're not going to get very valuable advice, I guess.
Yeah.
And then yes, to CDL, the mentors typically help these founders speak to the first customers, knock at the corporate doors, see how they respond. But equally, if they're considering investment, they will be a friendly voice that can kind of look at what are the investment terms, what are the corporates asking from you, how much equity do they want, are they happy to take another corporate on board? And not all of them are, but sometimes that's quite a good idea for early stage founders. So that's where the Creative Destruction Lab is quite helpful then, to have someone in your corner of the ring who's actually built a significant business before.
Yeah, and I've been a mentor on that at CDL, and been able to introduce some of the early stage businesses to the likes of Dow and Evonik and Henkel and all that, to help the communication from both sides in that, and asking for advice rather than asking for money often is a better way to sort of start. A question here from the on Slido. For the portfolio companies that become suppliers, how do you avoid conflicts of interests for sharing commercial sensitive information? And also, Neil's just touched on a point here. Sometimes you don't want to take investment from a corporate, because I've seen that in the past. If you take investment from one big IT company, then maybe others will say, oh, well, you're going to leak information, or why would I want to partner with you in that as well? So maybe deal with those two items in terms of how do you maintain some distance doing the investment as opposed to partnering or sort of supply side. Do you want to take that first, James?
Well, it's a great. Is this on? Yes, there we go. It's a great question, and I think there's a couple of different ways I would answer this. I mean, we're two distinct teams in terms of our environmental sustainability procurement team versus our climate innovation fund team. We will, as I said earlier on, we will partner together sometimes. You know, we will lean on our procurement team and their subject matter experts to help us with some of our due diligence on deals, for example. But of course, there's many deals that our procurement team are working on that we don't know about. So we would typically reach out to say, hey, we're exploring these guys. We'd love to have one of your SMEs help us with the due diligence. And so I think that's just a really good partnership in terms of the way we work together. Unless I've missed it, I haven't seen any conflict there, by the way, so far. So
Okay.
that's not really something I can comment on. And remind me of the second question to that, sorry.
So just if they become suppliers, or if there's conflicts, or is there potentially that you get too close to a startup and invest in them, but decide not to invest in the next round? Is that a bad mark? And you might have good corporate reasons why you're not going to invest, but do you see that conflict or challenge in that with a corporate partnering with a startup?
Not necessarily. We always look at operational alignment. That's kind of one of our core criteria, which you'll see on the website as well. So if we do explore follow-on rounds, then we want to make sure that from our own kind of operational alignment perspective, that that's still kind of relevant, still aligned. And so that's obviously a really helpful lens for us. But if I flip it on its head slightly as well, one of the big focus areas that we actually have within the team is to really help our portfolio companies to scale. So actually, a lot of the portfolio companies have the potential to become commercial partners as well, if that's relevant. So hypothetically, we explore things like how can our technology platforms, how can our commercial partnerships help your business to scale? And I think that's really interesting, because instead of thinking about conflict, we're also looking at those partnerships becoming more strategic, and that opens up a whole load of additional opportunities in terms of leveraging some of our startup programs, where we offer things like over $150,000 worth of cloud credits, if you like, including free licenses and so on. That's a program we call Founders Hub. But then there's also our certified partner program that opens up additional benefits. And then there's more of our kind of joint selling motions that we have with our commercial sales organization. So that's another team that we sometimes pull in to really help think about, with some of the portfolio companies that want to leverage some of those programs, how can they leverage those, and what do those partnership models look like? So, as I said, instead of maybe thinking about conflict, think about those wider opportunities of partnering together.
Good. Irina, building on that, but you see the same thing, and also there's an additional question coming in of sharing off-takes with other sort of corporates. So if you find a great technology and you're putting it into your value chain, shouldn't you be sharing that with the other steel manufacturers or other sort of sectors and that as well? So what's your view on this, being a supplier and the more general ecosystem?
I'll build on James' points, because I think indeed you should frame it as a partnership, because if you take a step back, what are we talking about? We are talking about decarbonization industrial technologies, where when you were talking about various criteria, how you evaluate, for us, it's indeed differentiating technology, but the second element is it scalable? And some of those startups, something that works in a lab might not necessarily be industrially scalable. And this is when they come to us. So it's more of a partnership. It's not about conflict of interest. It's more of a partnership working with those startups to see if we can pilot their technology in one of our facilities, if we can deploy their technology in some of our sites, and really working with them on this roadmap of how can they get to the commercial scale. I think at this stage, when we talk about some of those fundamentally disruptive technologies, you don't get to think about conflict. It's the opposite. It's about how do we work together to ensure that we scale them up in the most optimal pace and that we meet our net zero objectives along the same lines. So I wouldn't, I think I would frame it entirely different. Maybe in some other industries, it's going to be more applicable, speaking about offtakes. I think, I'm speaking about specific technologies. I don't think it's a niche. Well, I don't think it's the main challenge that we should be focusing on. I think the main challenge should be, it's a very capital intensive industry. I was reading McKinsey report, and I think they have estimated that in the next 10 years, you'll need like more than 150 billion to decarbonize steel making, and by the end of by 2050, it's more than 4 trillion. So we're talking about trillions of capital to get there. So it's not kind of time to think about how conflicted or if there is some conflict of interest. It's more how we can expedite, how we can accelerate, how can we get some of those technologies which are facing now some of these chicken and egg challenges that they're not economically viable because you really need to get them to scale to get to this optimal cost, and they cannot get to scale because they cannot get the funding given that they're not economically viable now. So
Yeah.
it's more teaming up with the corporate, finding a way how we can deploy. So I think I'll just frame it this way because I think it's much more relevant.
Okay, and from Julian and Niels, what's your perspective, almost coming from the startup side, because you're helping them at the side? What's the challenges of engaging with these corporates as customers and then potential sort of scale-up sort of partners? What's it?
Certainly, there can be a concern. I think particularly if there's one corporate, that can be a concern that one corporate could have more influence as a VC. So we often prefer to say, well, it might be better to have two rather than one. But it depends on the nature of the corporate and the nature of the investment. So as I mentioned earlier, with Sainsbury's Innovation Investments, Sainsbury's has no intention to acquire the company, so it's not really a corporate VC in that respect. So it does depend on the nature of the investment, the nature of the relationship as well. But certainly it can be better to have two rather than one to avoid that slight risk, I suppose. In terms of the earlier point about how you handle that flow of information, and is there a risk of like a conflict of interest between a supplier relationship and the VC relationship? I think that's a very valid concern, but it's actually not difficult to handle. We would just have a Chinese wall, so there would simply be one team who has access to one set of information, the other team has access to the other information, Chinese wall between the two, and it hasn't been a concern so far.
Good. Niels?
Yes, I think, well, there's a lot of things that resonate, obviously. I think what Microsoft is doing makes a lot of sense in the way that they would invest in something that isn't really their core business, so the conflict there is not really there. At the same time, I think what Irina has been talking about is super valuable when the corporates engage with the startups at this early stage. We have a lot of very technical startups. They come at it saying, look at the technology I've built, but they don't understand the value of it, and they struggle with that. They struggle when they're fundraising with translating their technology into benefits in monetary terms, and then that makes it really hard to fundraise for them. So if they have this kind of engagement with the corporates, that help them say, look, this is actually where you're at, this is what your value proposition could look like. If they can write a case study together with them and say, this is what we've achieved, the ROI we've gotten out of this pilot, then that unlocks a lot of capital from other sources as well. So it can be quite catalytic. But yes, I mean, we would recommend that maybe they have several corporates invested or just engage on a non-investment basis so that they have these like supplier agreements.
Okay.
Because yes, if you think about having someone who does invest as a potential acquisition and it's only one corporate, then obviously you're not attractive to any of the other
Yeah,
corporates who might want to buy you, and then the one that you've got on your cap table will dictate the price. So
Yeah,
avoid that.
Which isn't of interest to the rest of the investors or the founders and that as well. I think you've got to remember you're all around the table. A couple of questions that we can probably hit off very quickly here for each of you. What's your typical check size? And how long is it going to take from filling out that information on the website to you giving that check? So just, I guess there's only two numbers we need, the value in pounds, millions or hundreds of thousands, and numbers of days.
Yeah, so I think typically the smaller investment has been around the 3 to 5 million mark, but we have our fund managers that will invest in amounts less than that as well. And in terms of timeline, or maybe 12 weeks, 12 to 16 weeks, I would say.
There's some grimaces around the room. Okay, James, right? Irina, what's your sort of typical check size and time? Try again.
Can you hear me now? The previous investments we made were between 5, 10, 15, 20 million, but we also ran an accelerator, which is more what James was referring to, 3, 4, 5 kind of single million between 1 and 10. And how long does it take? It really depends. We had some cases where it took less time, and some cases, again, we are talking about industrial tech, where we would engage with the startup and we would work together on testing some of the solutions. So it can take, several months, but it can also go faster.
Okay. And Julian, with Sainsbury's is new, but the previous Foresight funds and experience you guys have got?
Well, for Sainsbury's, the typical check size is 500k. And in terms of timescales, again, it depends, but typically probably 3 months. It can be quicker if it's a straightforward case, but before you assume that yours is a straightforward case, not that many of them are. So I'm going to say typically 3 months.
Good, thank you. Any perspectives, Niels, that you've seen?
No, that all sounds fairly standard. I mean, we don't invest, so I can't really comment.
Okay, so we've come to the end of our time. If you join me in thanking the whole panel for their insights. I know we didn't get some of your questions, but feel free to ask one-on-one when you get the chance. Thank you very much.